Banks. They're literally the heart of our economy, right? But trying to figure out if one is healthy or not, well, it can feel like you're trying to crack some impossible code. So today, we're going to change that. We're handing you the professional's toolkit to look right inside the vault and analyze any bank with real confidence.
Yeah, if that sounds familiar, you are definitely not alone. For most of us, a bank's financial statements look like they're written in a totally different language compared to a normal company. It just feels impossible to judge their true health.
And that right there is the key thing you gotta get. You just can't analyze a bank the same way you look at Apple or a car company. It won't work. Banks don't really sell products, they sell money itself. Their whole business is this high-wire act of managing risk. And because of that, they need a completely different way of looking at them.
All right, so here's the game plan. We'll kick things off with why banks are such a unique beast. Then I'm going to give you the core analyst toolkit, the essentials. We'll uncover the one number that regulators watch like a hawk. After that, we'll put it all to the test, comparing private and public banks. And finally, we'll show you exactly how to spot a winner and, maybe more importantly, a disaster waiting to happen.
Okay, so let's dig into that foundational rule. What is it that truly, fundamentally separates a bank from every other business on the planet?
You know, on the surface, the business model seems simple, right? They take our deposits, the money we put in our accounts, and they lend that same money out at a higher interest rate. That gap, that's their profit. But the real game, the thing they live and die by, is managing the huge risk that those loans won't get paid back. It's this constant, delicate balancing act between making a profit and staying safe.
So how do we actually measure how well a bank is playing that game? Well, that's where our analyst toolkit comes in. We're going to focus on 4 key ratios that just cut through all the noise and show you what's really going on with a bank's performance.
First up, the CASA ratio. Okay, think of current and savings accounts. That's what CASA stands for, as a bank's cheapest source of raw material. It's the money we all park with them that they then get to use for lending. So a high CASA ratio means the bank has this stable, incredibly low-cost river of funding. And that, my friends, is a massive competitive advantage.
And you can see this in action, right? A top private bank like HDFC is an absolute master at this, with a CASA ratio of around 48%. That means almost half of their funding comes from these cheap, super stable sources. And then you have a giant public bank like SBI, which is also incredibly strong at 44%, really showing the power of its massive nationwide branch network. Anything above 45% is considered best in class.
Okay, so if CASA tells us about the cost of their money, our next tool, net interest margin, or NIM. Well, this tells us how profitable they are when they lend that money out. This is pretty much the ultimate measure of a bank's core profitability. And with this one, higher is almost always better.
And NIM, it tells you so much about a bank's strategy. A premium private bank like ICICI, for example, can command a really high NIM, around 3.8%, because they focus on higher yield loans. But then you look at public sector banks. They often face brutal price competition, which pushes their average NIMs down to around 2.6%. That difference might not sound like much, but it's a direct, massive hit to the bottom line.
All right, a bank can have fantastic margins, but what happens if its customers just stop paying back their loans? That's where the gross NPA ratio comes in. NPA just stands for non-performing asset, a fancy term for a loan that's gone bad. This number is a direct health check on a bank's loan book. It tells you straight up what percentage of their loans have gone sour.
Now, with this one, lower is always better. It's like a golf score. And it's the clearest sign of who's good at managing risk. HDFC Bank is truly in a league of its own here, with a gross NPA of just 1.3%. Now, while SBI's is much higher at 4.9%, it's really important to see that it's been on an improving trend. Just for some context, anything below 1.5% is excellent, but if you see a number over 5%, that's a pretty significant red flag.
Okay, so we've talked profitability, we've talked loan quality, but there's one number that the regulators care about more than any other. This is the ultimate final word on a bank's safety.
And that number, the magic number, the one line in the sand for the entire Indian banking system, is 11.5%. This is the Reserve Bank of India's minimum required capital adequacy ratio, or CAR. Every single bank must stay above this line, no exceptions. It is the single most important safety metric of them all.
So what is this CAR anyway? Just think of it like the bank's own capital.
It's financial cushion. It's the shock absorber. It's the buffer that's there to soak up unexpected loan losses without ever touching your depositor money. So the higher the CAR, the bigger the cushion, and the safer the bank is. A really strong bank will have a CAR well above 15%.
All right, you've got the analyst's toolkit. Now let's put it to work. I find that a head-to-head comparison is the absolute best way to see how these numbers really bring to life the fundamental differences between private and public sector banks.
You know, it really boils down to two totally different philosophies. Private banks, they're built for speed and efficiency. They use technology and aggressive strategies to win. Public sector banks, or PSBs, on the other hand, are built for scale and stability. They leverage their massive size, their deep reach into rural India, and of course, the unspoken backing of the government.
Now look at this. This snapshot of ICICI versus SBI, it tells a really fascinating story, doesn't it? Their CASA ratios are pretty close. I mean, both are excellent at gathering those low-cost funds. But then look at the NIM. ICICI's higher margin clearly shows its focus on profitability. But the biggest difference? It's in the risk. ICICI's gross NPA is significantly lower, which points to stronger asset quality. And finally, look at that CAR. ICICI's massive 19.1% shows it's extremely well capitalized, while SBI is solid, but is clearly operating with a thinner safety cushion.
Okay, so how do we pull all of this together and actually use it to make smarter investment decisions? It's all about building a consistent process, a system to separate the winners from the potential landmines.
And you can do this with a simple 4-step analysis. First, just understand the bank's core business. Are they a retail bank, a corporate bank? Second, and this is crucial, look at the 5-year trend for these key ratios. Don't just rely on one quarter's numbers. Third, do a real deep dive on asset quality, because that's where the biggest dangers almost always hide. And finally, always benchmark the bank against its direct competitors.
And while you're doing that analysis, here are the big, flashing red flags you absolutely need to watch out for. A steady, consistent rise in NPAs is the #1 warning sign, period. A falling NIM tells you there's intense pressure on their profits. And definitely watch out for a revolving door in the executive suite. A KAR that's getting dangerously close to that 11.5% minimum, or any penalties from the regulators.
You know, at the end of the day, analyzing a bank isn't really about trying to predict the stock market. It's about understanding the business. And with this toolkit, you can now look right past the headlines and assess the health, the risk, and the strategy of any bank for yourself. So, the only question left is, which bank are you going to analyze first?